From Amazon to Google to Micron, a flurry of investment into India has been announced during Narendra Modi's trip to the United States, with even Elon Musk declaring that he's excited about India's future. It's a sentiment investors appear to agree with. Foreign buying has propelled India's Sensex and the broader Nifty to new highs in June.
We are seeing economic momentum improving in India. The PMI is actually extremely strong. Consumer spending is also picking up quite strongly. We are actually bullish on India.
Key to this is optimism that India's burgeoning middle class will boost spending. By some estimates, 1 in 3 Indians are currently within the middle class. That number is expected to double within the next 2 decades.
What you're bringing to the table is a population of approximately 1.4 billion, of which 522 million have an average median age of 29, all working population that can contribute to the economy.
Investors are also betting that India will become a major exporter of manufactured goods, as it benefits from a global push to diversify supply chains and reduce reliance on China. Coupled with the economic slowdown in Beijing, that's making India an attractive proposition for foreign investors.
The structural headwinds that are playing on China also means that China cannot any longer provide that additional alpha that it used to provide in portfolios at one time. And that's prompted a lot of investors to look beyond China into other emerging markets and where opportunities could be.
If you look at the last 5 years, if you are invested in India on dollar terms, you will be up 70% compared to, let's say, if you invest in China, for example, the last 5 years, in dollar terms, you'll be down 30%.
It's recommended to begin investing in India through an ETF or through an actively managed fund. Analysts say you can expect returns of over 10%. Sectors to focus on include consumer goods, to take advantage of the rising middle class, and banking, which could get a push from digitization. That's expected to propel the e-commerce market to reach $200 billion by 2026, 5 times the amount a decade earlier.
So buyers and sellers transactions are now digital. That actually means that if money can flow with less friction, it also means consumption would increase. But also it will set the stage for the next round of growth of this digital economy.
Investors can also focus on manufacturing and infrastructure plays, given the Modi government's Make in India push, as well as the green economy.
EVs are now coming into play in a big way in India. So you have that also being a big driver in terms of where we are seeing growth. Of course, the renewables also, given Prime Minister Modi's aspiration to kind of achieve some significant growth numbers on renewable energy generation in the country.
A benefit of investing in India in this current economic environment is that it's less susceptible to global market shocks because of its domestic growth story.
And as long as employment rates are in good shape and you have people having the confidence, consumer confidence, which is relatively high even as of today, you have that market available for you. And that's probably a big factor that is protecting India from this entire global turmoil.
But as with any emerging market investment, there are risks. Volatility is expected, so investors should be prepared to ride out the business cycle. In addition, Indian equities don't come cheap. Some analysts have warned that companies could be overpriced, but they add that that's the price to pay for potentially double-digit returns.
The IMF is actually expecting over 6% kind of GDP growth in India over the next 5 years. And if you look at it in terms of nominal growth, adding inflation to it, it could be about 12%, 11 to 12% of nominal growth in India. And if you are an active investor in India, you could easily assume that kind of a growth to translate into earnings growth of about 11%. For an active investor, it could also mean growth of up to about 15%. So I think the market potential potential in India is still pretty significant despite the valuations right now.
If you add India into the allocation, it does reduce your risk whilst either keeping your returns intact or even increasing your returns. So I think that's a very crucial element, because a lot of the companies in India that you invest into are geared towards its own local consumption, its own local growth dynamics, which is actually very strong. So I think that's why having an India allocation, I think, makes sense for long-term investors.
In the short term, investors also have to consider that India is headed towards general elections next year, so some policy paralysis and volatility is expected. That's why experts say it's important to keep focused on India's long-term potential and be prepared to hold your investments for at least 5 to 7 years.
The high returns that we generate are also underpinned by high risks. And of course, India has its share of risks as well. Given that we are entering this phase of a global slowdown, potentially, that could also play its part in the Indian markets. So of course, I think investing in India is a game of patience.